So many people know that the most tax efficient way for a director to pay themselves is with a combination of salary and dividends. But what is the difference between them? And more importantly, how would you choose which one to do? So starting with the salary, the benefits are that you can build up your qualifying years for your state pension. You can take a salary even if the company's making a loss. It can make it easier to apply for mortgages. And as a salary is an allowable expense, it will reduce the company's corporation tax liability. But how do you decide how much salary to take? Well, you don't pay any personal tax on your earnings until you pass the personal allowance threshold, which is currently £12,570. And national insurance is also payable only once your income passes the primary threshold, which is also £12,570. But in order to get the state pension qualifying years, it must be over the lower earnings limit, which is currently £6,396. So sole directors tend to set their salary between the lower earnings limit and the primary threshold, and then take the remainder of the income in dividends. If there's two directors or some employees, you might be entitled to the employment allowance, meaning it will be more beneficial to both be on the higher salary of your personal allowance. So thinking about dividends, what are they? They are paid out of the company's profit after it's paid all of its liabilities, including its corporation tax. If there isn't any profit, then there can't be any dividends. They're paid out in proportion to the number of shares that the person holds in the company. Now, there's no requirement for the 100% of the profit to be paid out in the dividends. You can keep it in the company as retained earnings to be paid out at a later date or to use to purchase assets and etc. So what are the benefits of taking dividends? Well, they are taxed at a lower rate than a salary, and they don't attract national insurance liabilities for either the employee or the employer. There's currently a tax-free dividend allowance, which is £1,000. That's in addition to the personal allowance. Now, there are a few risks. So dividends are only paid out after corporation tax has been calculated and deducted. So they're not a tax deductible expense. They can only be paid if there's a profit for the year or if you've got retained profits. Your income can be unreliable if you're relying heavily on dividends. It's not a regular payment. And if at the year end there's not enough profit to cover the dividends, then they will be classed as a director's loan and will need to be paid back, or you will probably be taxed on that. So there are ways that we can help you make this kind of decision. During our initial meeting, we'll discuss your circumstances, work out the right mix of salary for you and your business. And it could be that the mix changes as your business grows and becomes more stable. And it also could be different depending on how many directors and employees you've got. We monitor your figures quarterly as part of our quarterly reporting, so we can keep an eye on your dividend levels to make sure you're not taking out more than you should be. And we can adjust your salary and dividend mix at any point, so we can stop you taking too much money before it becomes a problem. So if you want to know more, pop over to the Work With Us page and complete the questionnaire, and then we can book in a discovery call.